Now, here on the show, we're often talking about seeking opportunity in times of financial turmoil, uncertainty, and when the market is down, there might actually be a tax opportunity. It comes when you offset any gains with some of your losses. It's something that's called tax loss harvesting. Guys, do you mind explaining that a little bit more?
Yeah, happy to. Tax loss harvesting is generally works like this. What you do is you sell an investment that is underperforming and losing money. Then you can use that loss to possibly reduce your taxable capital gain and potentially offset up to $3,000 of your ordinary income. Finally, you can reinvest that money from the sale into a different security that meets your investment needs and an asset allocation strategy. And I think that's one of the great things about working with us at America's Retirement Headquarters is that comprehensive approach. The decisions that you make with your investments are going to impact your taxes. And you want to have these things kind of working hand in hand together. This is an area where I think it's a good idea to make sure that you're having a conversation with your accountant and your CPA, because what happens is when the ball drops and it's December 31st and the year is over, that kind of locks in what the tax numbers are for that year.
Mm-hmm.
So, what a double whammy it would be to have an investment account. You had maybe some sales that were made earlier this year, and you get a tax bill for a bunch of gains that you were not aware of until after the fact, to come to find out that at the same time your investment portfolio went down because of the market decline, kind of like a double whammy impact. That's why it's important to take a look at this tax opportunity and to do it at this time of the year, because the clock is ticking, time is running out. A couple of things that you want to consider. Number one is this doesn't apply to retirement accounts. So when we're looking at the tax loss harvesting opportunity, it's really looking at your non-retirement account. So if you have money set aside in an after-tax brokerage account or an investment account, that's where you're looking at these things. Maybe, from the sale of real estate or property. Those are the type of things that you want to be having a conversation with your financial professional and say, hey, where am I at on realized gains this year? There's also something that you need to consider, which is the difference between how short-term versus long-term capital gains are taxed. There's different rates that can apply for short-term versus long-term capital gains. And even when you get into the gains, the rates on the capital gains can vary too, which again is why it's a good idea to sit down and take a look at this. If you think about the tax code, it can stack on top of each other. It's got to be astronomically high. It's one of those areas that it gets very confusing. But as we know, the Honorable Learned Hand, he was a judge, he said there's two systems of taxation. It's one for the informed and one for the uninformed. We want to make sure that you're informed about this as an opportunity and make sure you apply it to your situation. I'll give you one example. If you had an investment A, and let's say investment A you sold and you had a $20,000 capital gain, the potential tax, if it's at a 35% rate, the potential tax on that would be $7,000. Now, you also have investment B, and investment B is at a $25,000 capital loss. What you could do is you could use that $25,000 capital loss to offset the $20,000 capital gain. That's potentially saving the $7,000 of the tax bill. You could then also apply the $3,000 to reduce the ordinary income tax. And again, assuming the tax bracket was 35%, that's another $1,050 in potential tax savings. And then you could apply that $2,000 future to gains in the future or income in the future. The total potential tax saving there is $8,050. So tax loss harvesting is something that you want to pay careful attention to. It is something that you want to take a look at. If you're not familiar with what it is, if you get a hold of us, we can take a look at your individual situation and make sure that there's some actions that are taken if they're needed before the end of the year to take advantage of this tax strategy.
It's kind of a double-edged sword right now because it being the end of the year, towards the end of the year, it's a perfect time to take a look at this. But also, there's not much time to do it because we're so close to the end of the year. So don't delay if you want to figure out how to, minimize some of the taxes that you have to pay. And I think that's pretty universal out there. Give a call. Let the team at America's Retirement Headquarters walk you through the process. If you've got a CPA, they'd love to work with them. If not, they'd be happy to put you in touch with one of theirs. But to get started, 419-794-3030 or go to the website, americasretirementheadquarters.com.